Cyan.
Not the easiest. I don't expect anyone to remember it.
Okay, welcome back everybody. An important part of living your life the way you want, of course, is to get enough money. To get enough money, you've got to get your mindset in the right place, got to position yourselves. Part of positioning and planning is, I guess, in simple, crude terms, owning nothing and controlling everything. Now, it's a bit rough that, but that's kind of what we're trying to do. So what I'm going to do now, I've invited New Zealand trustees to come along, and I'll get this wrong, Cyan. Cyan is going to talk to us today about some of the details and perhaps some of the changes that have taken place in this area in the last year or two. So over to you, Cyan.
Turn myself on. Turn Laura on. Cool. So I'm Cyan from New Zealand Trustee Services. We are a privately owned company with a branch here in Christchurch and one as well in Auckland. I am the office manager for the Christchurch branch, as well as the trust manager, along with Laura Anderson, who's come with me today. So we deal with the day-to-day administration of trusts. I'm on mic, that sounds funny. As well as the establishment of trusts and also looking at trusts that have already been established to see if they're correct. What sets us apart from other people is the fact that we are strictly trusts. We're not dipping our finger into other pies and doing other things such as accounting, solicitors side of things, all of that. So today we're going to cover off on the following. So I'll just bring it up. So we've got trust and their application in New Zealand, administrative requirements, the types of trusts, their uses, other devices we use, why are trusts under review, 75% are non-compliant, the abolition of gift duty, the implications surrounding that, and the future for trusts. So we're hoping to make today's session quite interactive, so we'll throw some questions out into the trust. And the first one is, why do people establish trusts?
Can anyone answer that?
Asset protection.
Yeah, so asset protection from what?
Creditors.
Yeah, so creditors. So if you've got a business and your business fails, if you've got a trust that's set up and has protected your assets, then if your business failed, then the creditors wouldn't be able to attack those assets. What other reasons are there?
Another good one is residential care. So if you go into residential care, you get asset tested. If you have it in a trust, they can only go back 5 years. So therefore, your assets are going to be protected from residential care fees.
So as of the 1st of July this year, the figures changed. It used to be $210,000 per couple. It's now gone up to $213,297 of assets or less. So, and that's including your house and car. So most houses are over that figure. If it's not including the house and car, then it's going to be $116,806.
Another real benefit for setting up a trust is for relationship property. So if you are recently separated or are single, this is the time to put your assets into a trust. So if you form other relationships, then those assets are going to be protected from any relationship property claims.
So you only have to be in a relationship for a period of 3 years before your partner's entitled to half of everything. And relationship property is a really grey area when it comes to going through the courts and what's deemed to be a relationship. We advise our clients that the right time to set up a trust is when you don't need it, because when you do, it's too late.
Another important one as well is if you have two trustees together and one of them actually pass away, that survivor is actually protected throughout their lifetime if they enter into new relationships or if they go into residential care.
So the trust is set up to ring-fence your assets, so going forward, nobody's going to be able to attack those. The other reason for a trust is legal action. So if you're in an industry where you're giving advice, if you're negligent for whatever reason, so if we use the financial sector as an example, if you give the wrong advice and lose your clients a whole lot of money, they're more than likely going to look to attack you to recoup those funds somehow.
Also, we can't see where ACC is heading. So if they cut ACC out of the picture, New Zealand will become more like America, where they try and sue you for your money.
There's also succession planning, so holding your wealth for the next generation and being able to pass that down to your kids. So we will go into detail shortly just in regards to inheritance trust and how you can protect that for your kids going forward. Does anyone have any questions? No?
Do you have a printout of your stuff or not?
Of our
We do.
stuff, we've got some brochures here that has got all the information that we're going through as far as today goes. Let's see if we haven't missed anything. There's also taxation benefits. People did set up trusts for their business side of things to flow through to get the tax benefits there. That's gone because obviously business tax is down at that 28 cents in the dollar now. There is still the income splitting side of things where you can assign income to beneficiaries, and it may be that you have a beneficiary on a lower tax bracket that you can assign those funds through to.
It's only if you've got your own business though, isn't it?
Even if you had the likes of investments, so if you were generating an income and you wanted to assign it through to someone, then you had that benefit to do it there. Does anyone have any other questions before I go to the next slide? No? Cool. So administrative requirements for trusts.
So now we've got the trust deed. This is the foundation for the trust. What we try and do is we make this as wide as possible. It outlines the powers that the trustees have throughout the duration of the trust.
So with the powers, they are very broad. So we've got the powers in there for you to subdivide and develop property. You can give guarantee for loans. You're able to rent. The trust is able to own life insurance, which we'll go into shortly. But we make the powers so wide so that you, over your lifetime and the life of the trust, which can run for an 80-year period, it allows for you to do what you want to do.
So the settlers are responsible for creation of the trust. So they are the ones that set up the trust. The trustees are responsible for running of the trust and holding the trust fund on behalf of the beneficiaries. The documents that we put in place alongside the trust deed, so for example, if we sold over a family home to the trust, we would have to put in place a sale and purchase agreement, a licence to occupy, giving the right to the tenants to occupy the property throughout their lifetime, meaning that they have to pay all the rates and all the outgoings. Because the trust has no money to pay for that asset, the clients take back an acknowledgement of debt. So what that is, it's basically like an IOU, and there you start the gifting program. We record everything in trustees' minutes, so whether the trust should take out any new loans, make any gifts to the trust, any decisions that the trustees make is recorded in a trustee's minute and held on the trustee's minute book.
So the minute book is different to an actual trustee's minute. The minute book is what holds everything for your trust. So that's the minute, it's your gifting documents, it's your agreements for sale and purchase, it's the declaration of trust, it's your living wills, it's your memorandum of wishes. So it's everything, so that if there was an audit of your trust for whatever reason, there's a clear paper trail of what your intentions for that trust is.
So we like to hold on file all the accounts for the trusts. If there is any investments, we'll have the investment strategy. We like to be the one person that has everything listed for the trust.
We also provide our clients with what we like to call a black folder, and that holds copies of all your documents, and you're able to take this away with you when you establish your trust. It then holds all your documents from there out until obviously the end of your trust. But it's also good for you to hold those documents, so if you've got an accountant, a solicitor, and they ask to see those, then you're able to provide them with it.
New Zealand trustees take the best practice approach. So what this means is when your trust is due for review, we make sure that we invite your insurance advisor if they need to be there, your mortgage provider, accountant, and we all sit around the same table to decide what's best for the trust and the beneficiaries. We like this to be working together and the client gets fully taken care of.
We all like to be on the same page. If we're not all together, then it's sort of Chinese whispers as to who's doing what for you and where you're actually going with your direction. So that's why we meet together. If we don't meet together with everybody on an annual basis, then we have an in-depth annual review form that we go through, and that covers off your insurances, your mortgages, your investments, that side of things. We know enough to be dangerous to be able to send you in the right direction. We don't advise you in that area though.
We also look forward for what the trust is going to be planning. So we set out goals, whether if the trust are going to purchase a new property or if they're going to start a new business. This is where the meeting that we do to find out what the game plan is for the trust. The types of trusts we set up, we can set up a family trust, a business trust, an inheritance trust, and a parallel trust.
So with trust, there's the thing where people think that they're going to lose control because they're selling it over to the trustees. But with our trust, we have the likes of mum, dad as the trustees alongside New Zealand Trustee Services, and we're just here to dot the I's and cross the T's to make sure everything's administrated correctly.
Cool, so what are the uses of the family trust? Can anyone tell us?
You can read it out. We've given you a hint. So, okay, we've got asset protection and wealth transfer. So again, like we say, for single people or people who are being divorced, before you enter into a new relationship and you've got assets, the best time to put them in is now, so we can put them into your family trust. Your family trust owns your personal assets, such as your family home, investment, your batch, insurances, that side of things, and it also just holds those assets so you can pass them down to the next generation.
What happens if you say, meet a partner within those first 5 years? Is it still legal there?
If you're in a relationship with somebody?
Forget about me, but if a family member has a family trust,
Yeah.
and they've just transferred the assets into it, does their partner still have a crack at it within 2 years, or is it going to be in there for 5 years?
If you've got, obviously when you transfer something into a trust, it's not protected overnight. That's where we've got to go through that gifting process at either $27,000 or $54,000 per year. You'll hear about the abolition of gift duty shortly. Anything that hasn't been gifted is likely to be attacked. We do advise our clients that if they are in a relationship and they're worried about those separate assets, to put in a contracting out agreement so that what they came into the relationship with and what the partners come into the relationship with, they'll at least leave with, and anything they've put in jointly, obviously they can split down the middle or separate it out how they want to. Does anyone have any other questions? No?
So now we can create a business trust. So what this trust does is holds the company shares on behalf of the business. So it keeps it completely separate from the family trust, and it just holds the shares. The benefit of setting up a business trust is to clip the growth. So for example, you set up a business trust and your shares were valued at $1 a share, and then in 20 years' time your shares are valued at $1 million. All that extra growth in between is captured in the trust and not in your personal names. So if you ever get asset tested, they can't asset test that growth.
We're going to talk about inheritance trust?
Yep, cool. We set up inheritance trusts for our clients as well. So what these trusts are is they're a trust set up throughout the parent's lifetime. They are the trustee and the settler of these trusts. And when the parents pass away, the children become the replacement trustee of these trusts. So instead of the funds to pass through from the trust to the child, it passes through to an inheritance trust. So it doesn't lose that ring fence of protection. It doesn't mean that the child can't use the funds to go purchase a home or pay off a joint mortgage. It just means that the funds are loaned out like a loan repayment, and then if that relationship falls over that the child's in, the funds can come back into the inheritance trust, so they can't get a relationship property claim made against them. Also the same for creditors. If your child's in a business and their business is failing, if the funds pass from their trust to their name, that can be used to pay creditors. But if it passes through from the family trust to the inheritance trust for the child, those funds are going to be protected.
The other thing is rest home subsidies. Again, people are living to a ripe old age nowadays. So if you've left your kids an inheritance and they receive it in their personal names, but they're heading into in a retirement home, then those funds are going to be asset tested against their personal name. So again, that's why an inheritance trust is put in place, because if it passes from one trust to another trust, there's no gifting required on that.
Yeah, the huge benefit as well is the parents set it up during their lifetime, and then if that child did get a creditor claim or a relationship claim made against them, they haven't put that asset into a trust to deprive themselves. the parents have set up that trust for them, so that means it stands really well.
Does anyone have any questions?
Any one of these trusts, of that, can you also have independent, like have an independent bank account as well? Does everything go into?
No, you can have a separate bank account, so you'd have obviously your day-to-day living accounts separate from what the trust would be. The trust would only have a bank account if it was generating an income, so if you had a rental property, you'd have that income coming into that trust account, and from there you'd use it obviously to perhaps pay the mortgage or to fix and do maintenance on the rental property. Does anyone else have any questions? No?
No? Just to let you know, the people that ask the most questions are in the Draw to Win Jonathan's book. So the other devices that we put in place.
Oh, hang on, we'll go.
Oh, actually, sorry.
We've got parallel trusts as well. Now we set these up for split families, so if it's somebody that's got children and then they've met a partner with children as well, it's advisable to set up parallel trusts, because if we set up a single family trust for them, if something happened to one of those parents and the remaining spouse ran the trust on their own, they could choose to kick that other person's kids out of the trust. So by keeping it separate, then it's obviously the transfer of wealth down to the kids and in the direction that person wants to go. We generally give the partners a life interest in each other's trust, because generally they purchase a house together, and it just gives them the ability to live in the house during their lifetime or until such time as they enter into a new relationship that's deemed to be going down the track of marriage.
So do you provide a service to evaluate current trusts?
Yes, we do.
We'll just go to that.
Obviously, when it comes to the courts, it's too late.
Yes, absolutely it is. So other devices we use?
So the other devices that we put in place for a trust is we update our clients' wills. So we make sure that they're aware of who they want their replacement trustee to be of that trust, who they're going to use as their executor, how old they want their children to be when they receive an inheritance, or if they want that inheritance to flow through to a trust. We make sure if they want to be buried or cremated. And then also we put in place a memorandum of wish. So if the clients have got any specific chattels that they wish to pass on, whether it be a wedding ring or family heirlooms, we make sure that it's listed clearly in the memorandum of wishes.
Also, the memorandum of wishes are read out if you were to ever become mentally incapacitated. It gives directions to your trustees as to what you'd like to happen in your absence. If you've got rental property, it may be that you want income to flow through to the beneficiaries. We also, enduring powers of attorney for property and personal care and welfare, our office can't prepare these anymore due to legislation change back in September of 2008. You now, if you want to prepare these, have to seek independent legal advice, to have these put in place. This was due to a growing perception of elderly abuse. Now, if you want to put these in place, you go and see a solicitor. Sorry, I've lost train of thought. Most people are choosing not to do these though because of the cost. It's skyrocketed. So if you don't have these in place and something happens to you and you become mentally incapacitated, your family would have to apply through the family courts for a protection order, which could take up to 2 to 3 months and cost around about $2 to $3 grand. To set them up through a solicitor, it's around about $600 to $900. So if you sort of weigh up the cost there and the hassle it would be on your family, it sort of far outweighs the cost to get them done.
New Zealand trustees review existing trusts. So if a trust is set up by a different lawyer or solicitor, a different lawyer or accountant, we review that trust to make sure that it's all up to date, that the clients are well aware of what clauses are in that trust, they're well aware of what powers they have throughout that trust lifetime, are the beneficiaries listed correctly. So we just make sure that everything's up to date for that trust, and if it's not, we can actually, if they have the power to resettle, we can put that into a brand new trust for them, or if they don't have that power, we have to set up a brand new trust.
We find with a lot of trusts that we review, clients have the sort of lack of knowledge of what's actually going on in their trust. Some of them aren't even beneficiaries. We've had clients that have come in with a trust and their solicitor was a beneficiary of their trust.
We also
Pretty
have,
sure you don't want that.
we also have a lot of clients that we take over their trust and they've never entered into a gifting program. So they've set up this trust and then it's just sit on their lawyer's shelf. So we just have to make sure that every step is processed and that the trust is fully compliant.
So another thing that we like to transfer over into a trust is insurances, being your life cover, trauma and total permanent disablement, being the lump sum payouts that you'd receive if something happened to you. If they go into the trust now while you're both living or you're alive, if it's just a single person, they come in at a nil value. Whereas if something happened to you and the remaining spouse decided that they wanted to put those funds over into the trust or purchase something in the name of the trust, that's again where they're going to incur that gifting program side of things.
So the owner of that life policy, for example, in New Zealand Trustee Services case, would be the two trustees and New Zealand Trustee Services. So when any payout occurs from that life policy, it would come straight into the trust. It's also very good as well as if the future person wants to enter into a new relationship, those life policies aren't going to be claimed as relationship property, and also residential care.
There's also the business factor of it as well. If your partner was in a failing business or you're in a failing business yourself, and all of a sudden you come into an insurance payout, creditors are going to come and attack those funds. Does anyone have any questions at all?
How do I have a trust?
Sorry, we'll go with you first. You're in the front.
Should you, I know you can have for 80 years, but do you have to have it for that full term?
No,
We don't have to have it for that full term. What we look at is we make sure what you want to achieve in that trust. So if it's when you both pass away, where do you want those funds to go to then? Do you want it to go to your children's trust or do you want it to go to their name at 25? We just look to what you want to achieve in the future.
So that's where your will come into
Yeah.
play, and that gives directions to your trustees as to what you want to happen after your death.
Have you got a question?
Yeah, I was going to say, I mean, I don't have a trust, but it's sounding like everyone should have a trust. What's the annual or setup cost of a trust?
So what we charge, every place is different. What New Zealand Trustee Services charge is we're 1,000 plus GST to set up the trust deed. So that's again the foundation document. We then have to put other documents in place. So for example, selling over the family home, your wills, living wills and everything like that. You're looking at around another cost of at least 1,200 around that mark, but it can vary depending on what you want to put into the trust.
The annual sort of maintenance?
The annual maintenance, what we charge is between 200 to 500 a couple. So just depends again on what we had to administrate throughout the year. If the trust takes out any new loans or anything like that, that's again on top of the annual cost.
Does anyone else have questions at all? We advise not to because people tend to keep things up here instead of on paper, whereas at least if you've got another trustee there to sign the documents coming through the door, then we're going to be here to dot the I's and cross the T's for you.
And also it's really benefit to have an independent trustee because then it means that it's not yourself owning that asset wearing a different hat, you're actually owning it in the trust.
Does anyone else have any questions?
When you fill out credit applications like businesses, you have to fill in a personal guarantee.
Are you talking about loans?
Oh, just, credit applications, loans or...
Yep, so the trustee gives the powers for the trustees to give and to guarantee for any loans. So again, that's where we come in to sign the documents.
So we just make sure that that guarantor is actually just all recorded in a trustee's minute just to keep it compliant. So the trust can go guarantor on any loan because we have that power in the trust, but you don't know if you have a different trust with someone else, you might not have that power.
The other thing we find is if we've got mum and dad as a trustee and they might appoint a friend or a relative of sorts, they're liable for anything that might come their way. So if the mum and dad can't pay the mortgage, then the bank can go to the friend or the relative and say, blah blah's fallen short on the mortgage. It's now heading in your direction and you're going to have to pay it. Whereas for us, as an independent trustee, we have a limited liability clause in any guarantee documents, so we're not held personally liable.
Why would somebody come to New Zealand Trustee Services to set up a will rather than just go to a lawyer?
For just a will, they can go anywhere. for a will, because they're so basic, it doesn't take into account the trustee side of things. It just takes into what you want to happen to obviously your assets when you pass away.
And if you've got a reasonably complex sort of will scenario, I mean, would you be good to go to someone like yourselves or to a will?
It doesn't, wills not so much. We do just wills for some people, but we tend to send them off in the direction of the solicitor, because most of your dealings, if you don't have a trust, will be through your solicitor anyway. Are there any other questions? No?
So now we come to the 75% of trusts are non-compliant. So this is why we want to ask you some questions. So do you know where your trust minute book is, if you have a trust?
Who here has a trust, first of all? Yeah. Do you have an annual review? Yeah. Do you know where your minute book is? It's on the couch. Collecting dust. So the reason we find that 75% of trusts that come through our door are non-compliant are there's no minutes recording the movement of assets. So the trustees may have purchased and sold a house, but there's been no minutes to record that the house was actually sold and what happened to the funds after that. There's just no general recording of any decisions that have been made. They've just been tucked away in a bookshelf somewhere, and that's where it's sat collecting dust. Again, no annual meetings, and these are more crucial now since the abolition of gift duty has come into play, because we no longer have to file gift statements with the IRD. Everything's now done in-house, so there needs to be a very clear paper trail as to what's happening within a trust.
There's no understanding of the trust deed, so clients don't understand what is in their trust deed and what powers they actually have as a trustee.
All trustees are not involved. Our trust deed states that all trustees' decisions must be unanimous. So for whatever reason, if you're selling a house, getting a bank loan, then we need to sign those documents. We've got trustees making assumptions. We've got intermingling of trust and personal monies. So some people with trust bank accounts will use it to buy their daily coffees, when clearly it needs to just be used for your trust side of things.
We've got husband and wife as sole trustees. So when this happens, they normally keep all the trustees' minutes and decisions in their head, and they don't have it written on paper.
And then we've got lack of knowledge in education. So again, people not knowing whether or not they've done a gifting at all, whether or not the house is actually being transferred over into the trust, and generally who the trustees, beneficiaries and that side of things are. Does anyone have any questions at all? No?
Cool. Now we'll go on to the slide on the abolition of gift duty.
That will let me.
So as of the 1st of October 2011, there has been some changes in regards to gift duty. So what that means is now you can gift more than $27,000 into a trust without accruing tax. However, not all well and good as it sounds. There's been no changes in regards to wins. So what that means is if you make a gift over and above $27,000 to a trust, that gift that you make has got no time frame to be asset tested against your own name if you went into residential care at any stage in the future. So for example, someone in their 20s makes a gift of $300,000 to a trust, and then in their 70s they go into residential care. That gift that they made in their 20s, $273,000, will be asset tested at their own name, and it has got no time frame. So it's not 27 times 30 years, it's when that gift is made.
So there's other issues obviously surrounding making an extraordinary gift. If you're in business and the business is failing, then obviously you can't just put your asset into the trust and gift it off in one day. Creditors are going to see it as you trying to defeat them. Again, property relationship issues, same thing. If your relationship's failing, you've got a separate asset, you can't put that over into a trust, gift it off in one day, because your partner's going to come along and say you've done that to defeat them. Government subsidy issues are exactly the same. You can't gift the whole lot off in one go and pop along to Wins the next day and ask for a benefit. They're not going to give it to you. Does anyone have any questions?
In your experience, when aggressive creditors attack someone that's got a business and a trust and they go through the unwinding process, who normally wins that fight?
It would really depend on where the gifting process and that side of things were at. If you had assets sitting out in obviously that haven't been gifted, they're going to come after those funds.
But if your trust is fully compliant and you have everything gifted off, we normally win. Yeah.
If you started a gifting program though when you were insolvent and they could prove that and they could go back 10 years to where you were insolvent, they'd probably be able to overturn it and it'd be obviously exposed to being attacked by them.
So some of our clients are making large gifts, but those are the clients that are multi-millionaires, don't care about rest homes because they can probably go buy their own. So that's what we're looking at. When they sign the deed of gift, if they are making a large gift, we make them say that they're not doing this to defeat a relationship. They can still pay all their debts as they're full due. They're not doing it to defeat any creditors, and they're not going to be applying for any residential care grants.
It really is case-by-case basis for doing an extraordinary gift. We find that the rest home side of things is a major driving force for people not gifting the whole lot over in one go.
Has anyone got any other questions about abolition of gift duty before we move on?
Yeah, I still don't quite understand your very first interruption.
The first one, on wins?
Yeah, in terms of the, if someone gifts a house worth 300,000 early on in life, how does that work with wins 50 years later? Because my understanding was that wins would look back up to 5 years.
Wins can look back 5 years in a trust if you gift at $27,000.
Mm-hmm.
So if you have everything gifted off at $27,000 each year, 5 years before you go into residential care, you can apply for your grant. But if you gift anything over and above $27,000, that's got no time frame and wins can go back X amount of years.
So are you saying that the 27,000 still stays as a figure, however there's no gift duty
Correct.
if you're doing 28,000?
Yeah, legislation surrounding gifting hasn't changed.
Okay.
So the government hasn't actually said what a gift is. 27,000 has always been that safe figure that everyone's been able to do. So we have to wait for trusts to go through the court system to see if things will change there. If gifting had gone up at the rate of inflation, it would be sitting at around about 78,000.
Right. Okay, thank you.
Does anyone else have any questions before we move on?
How does that apply when it comes to the rest home clawbacks? If you've gifted across a heap, how far back can they go?
If you gifted the whole amount, then they can go right back to the day when you gifted the whole amount. Otherwise, it's 5 years if you gift it $27,000 per year.
If it was gifted out of $27,000,
Yes.
say over 3 years, and there's a balance remaining, can they still crack you on the balance remaining?
They could, yes.
It's transferred over, say, October last year?
The whole, if you gifted off the whole lot?
No, the balance.
The balance, what was the balance?
I've forgotten offhand, but it was way above the $27,000.
So again, this would depend on the whole 213,000 being the rest home subsidy side of things. If it falls under that with combined assets that are either in the trust or in your personal name, then you might get away with it.
Gotcha. Thank you.
No worries. Anyone else have any questions?
One down the back.
Yes? Do you want the mic?
Not really. I'm allowed.
I know the feeling.
Can you explain the difference between an ordinary trust and a mirror trust?
Mirror trusts aren't used very often now because the beneficiaries of a mirror trust will usually be husband and wife being the beneficiaries of each other and they're not the beneficiary of their own. That's where we use parallel trusts nowadays because husband and wife will be the beneficiaries of each of the parallel trusts and they'll be given that life interest.
What's the difference between a parallel trust and a parallel will?
Oh, I don't know. Never heard of a parallel will.
I've got something like that with my lawyers anyway. Your wills are mirrors to each other.
That'd be very similar if it's to do with your trust because when you pass away, and obviously when your wife passes away, everything will come into your trust. We call it like a boiling pot almost.
Yeah.
And from there, then it filters out to where you want it to go. So it more than likely will go down to children. If you've got no children or grandchildren, then it will go out to family members. So it's almost like you have sort of a 50-50 share as such with your wife or partner.
Yeah.
And then from there, that 50-50 share is divided how you'd really want it to go.
Gotcha. Okay, thank you.
So this is new to me. before they changed the law, we went to a trustee and they said, with the new law, you'll be able to put the whole house into the trust, and then after 5 years, then the residential care rules and things won't apply, and you'll be fine. So what I've just heard you saying
That's
is
not
that
the case.
that's
No, that's incorrect
wrong.
advice. Yes. Yeah.
Hmm.
Yeah.
So
We've
they-
got brochures at the front that
Oh,
clearly
my goodness.
explains the changes of gift duty. And our director, Jonathan Cron, has been working quite closely with Peter Dunn as well. So again, what the advice that we're giving has come straight from the horse's mouth.
Okay, so the future of trust, so we're hoping it goes down the same track as the financial sector. We're hoping that we'll have very similar regulations as to what obviously the financial services does, so that there are increased awareness of the benefits, and that applies for all sectors being able to sort of have that advice and to sort of be dangerous with it so they can point people in the right direction. Obviously, if you had assets in your personal name and nobody ever mentioned a trust to you and somebody died and then you entered into a new relationship and those funds were attacked, you know, we want people to be able to point you in the right direction to know, you know, what you can put in place to protect those. We want clients to look to be educated to know what's actually happening within their trust and to be able to ask the right questions. Increased need for inheritance trust, and again that's that deprivation of assets from partners, and that's more for parents to set up for their children so that what they've worked so hard for during their lifetime passes down to their kids and it's then protected. Again, increased accountability for trustees, so much like the financial sector, if you are giving advice and you're negligent, then you should have, you know, people should have the right to come after you and recoup funds and that side of things. And then there's increased transparency, need for the administration to be perfect, and again, that's because we no longer have to file anything with the IRD. It's all kept in-house, so we're really the only ones that know what's happening, so we need that clear paper trail, so if your file was ever picked up and audited, then people know what's happened. There's huge opportunity to add value, and again, the add to need meet financial services regulations. Does anyone have any questions at all?
In your experience so far with the change in the rules, have the IRD gone after doing many individual audits of smaller trusts, or have they gone after larger?
I don't know of any.
They haven't audited any of our trusts yet.
Yeah, and I don't know of any that have been audited, but obviously there's no funds going into those people that were working for the IRD and doing the gift statement side of things, so that money would have gone into the new focus of looking at trusts more in depth now.
With an inheritance trust, are you actually locking your kids into something you wish, or can they then go and modify it?
They can modify it. The trust deed has a deed of variation clause, which gives them the ability to change it. When we set them up with mum, dad being the settler, the trustee, and the appointer during their lifetime. On mum and dad's passing, the kids become the replacement trustees as well as the appointers of their trust. As an appointer, they have the right to hire and fire the trustees, to add beneficiaries and that side of things. So they've got some wiggle room in it.
Any other questions?
Is it 27,000?
Go away from the mic.
Is it 27,000 per person, or is it?
It's 27,000 each, so 54,000 a couple.
Okay.
Yeah.
Any other questions at all? No? No, excellent. Well, that concludes our seminar for today for us.
So we'll leave brochures up the front, and along with mine and Cyan's business cards if you want to get in contact with us.
There's also just a couple of family trusts in New Zealand that have actually been written by our director, Jonathan Cron. I don't know how you want to do that. You might do it later on during the day, or if you want to do it now. I don't know how you want to work it.
Yeah, we'll just do it, they can do it later on during the day. So Jonathan Cron's our director, and he lives up in Auckland, and he wrote his own book. Cool.
Well, thank you both, ladies. That was great. Thank you so much. One of the things that, and only I would think of this, is I was interested in what you were saying about the threshold for gifting at $27,000 a year, and if they'd inflation adjusted it, It'd be more like 70,000 or whatever. This is one of the government's cunning plans. All governments do this. What happens with government is that they start off, and it's all well-intentioned with a few people around a table. Go a few decades later, government grows and grows, and eventually becomes unsustainable to the point where taxes have to increase. There's not enough GDP from the economy to support government, and they start borrowing. And one of the tricky things they do is print money. They also, when government benefits are given, they tend to not raise them at the same pace as the cost of living rises. And in short, this is one of the cunning things that goes on with government, and it's something to watch out for. But look, thank you for your talk. It was great. Thank you very much.